this video, I'm going to cover why I believe now is the best time to hedge with algorithmic trading and why modernizing your portfolio should be top of mind. Now, everything that we're covering here obviously carries risks. Trading is not suitable for all investors. You can read this disclaimer and all of our disclosures at our website. Now, you're watching this video because you're likely an investor who is noticing the market fluctuate, going up and down, and you're unsure how to take advantage, and you don't want to be glued to your screen all day trying to trade it overall. Now, one of the greatest investors in the world, Warren Buffett, arguably the best investor in the world, has stated that market fluctuations are your friend, not your enemy. And so you want to profit from the folly rather than participate in it. And what he means by that is you don't want to get caught up manually buying and selling every single movement in the market because you will not make a consistent trading profit doing it manually because you are all based on emotion. We're emotional creatures as humans. But really, volatility in markets means opportunity. And that volatility spikes when a macro political event occurs. That's when investor sentiment moves and they sell positions. The market overreacts and oversells. And then buyers flood into those assets. And really understanding what the opportunity is inside of market volatility is what allows people to take advantage of it. Now, most people think that they have to wait for the right time and have to wait for an event just like this in order to take advantage of these swings to buy assets at a lower price. Whereas a whole other camp of investors look at this market volatility and want to make money during all of this, regardless if the market goes up or down, but to profit consistently from this activity. And that's where algorithmic trading comes in. See, the problem is that most opportunities are missed, not because you don't know these quotes from billionaires, but it's because it's due to relying solely on your own efforts to take advantage of these times. And they can happen at any moment. You may be traveling, you may be on a flight when something happens, or you just may not be adequately prepared for those swings to occur. Now, if you've watched my prior videos, then you know that Jim Simons was sort of the godfather of this algorithmic trading industry, and he consistently produced about a 66% per year return that compounded over 30 years. And the reason he was so successful was because the trading patterns and the trading softwares were taking advantage of the volatility the entire time. Rather than simply waiting for a moment or waiting for a correction to occur, he was taking advantage of markets no matter what was going on. And so that's why institutions and markets have evolved to an algorithmic approach. See, trading algorithms now represent about 60 to 80% of all the activity going on in financial markets. And so now algorithmic trading is representing about $3.7 trillion dollars every single day, switching hands all based off of algorithms. And so this industry is growing at a very rapid rate overall. And so when people hear this information, they ask themselves how they can get involved. And so there's different ways to get involved if you look at the entire algorithm market. See, algorithms, there are different definitions depending on who you're speaking to of what an algorithm is, what it does, or to the extent of what's built into it. And so there's really four main types of algorithms. There are signals, which are usually done by manual traders. There are indicators, which make some fancy colors on the chart. There are single asset strategies that trade a certain pair or only focus on a certain pair overall. And then there's diversified execution strategies that are looking at multiple markets all at the same time and making uh, asymmetric risk reward trades, long and short. And that's what we do here at Algo Alpha. Now, the key markets that algorithms are prominent in are shown in this bubble here. Now, when they hear this information for the first time, the first question that we typically get asked is, well, how do we manage the risk associated with the algorithms? And that really comes down to the type and obviously the company that you are working with when it comes to algorithmic trading technology. We typically say that signals are the highest risk, not only on a strategy, but the execution, because the strategy risk is this even a good time interval? Is this a good pair? What's the leverage that they're saying to put on the trade? And if they sent that at 9 a.m. and you saw it at 3 p.m., you're typically wasting your time trying to chase that trade if it's a intraday trade. The second type of algorithm is typically an indicator, and indicators can look all fancy And they're looking for pattern recognition, but a lot of times indicators and the users of indicators typically start to get crowded out, meaning that the indicator will continue to ping the same signal over and over again. Sometimes it plays out, sometimes it doesn't, because it doesn't factor in other elements of market sentiment or order flows or anything like that. And so an indicator typically is just limited to a single chart pattern. A single asset strategy may compare a lot of things happening around that asset and the movements in that asset. So it's better than an indicator. So that execution risk kind of comes down to more of a moderate or medium risk threshold. But the problem with just a single asset approach is that then you're heavily concentrated all into that one. And so what we focus here at Algo Alpha is a portfolio execution type algorithm and strategy across multiple portfolios. That way we are diversified, but also because we're executing across multiple markets and we understand the implications of that and it being able to read and be diversified into multiple subsystems, the execution risk is low. And so understanding that, then people ask us, well, how would this look like if I integrated this into my portfolio? And so what I'm about to cover here is a hypothetical result. All of our trading algorithms and the data that you see online is verified and live. But in this scenario, we're going to be going over a comparison between different types of portfolios and what it would look like with it back tested to have algorithmic trading as just a portion of the portfolio. So this is not a forward-looking statement or a performance guarantee. This is mostly to show you what algorithmic trading could do in a hypothetical scenario based off of our data back tested. Now, the portfolios that we selected here were a traditional portfolio of stocks and bonds. Then we did a second portfolio where it was traditional stocks and bonds about 90%, and 10% of the capital is placed in gold. And then the third was 60/20 traditional. And then the remaining 20% was gold and algorithmic trading with our software. Okay. So this illustration will show you a hypothetical example of what this could look like from November 2015 to November 2025 is when we ran the scenario with a $200,000 portfolio broken up into those baskets. With the S&P only, your account would have grown from 200 grand to 776,000, which is about a 287% return. Scenario number two was the split with gold, no algorithmic trading. It would have been a little bit lower, 601,000, which would have been 200% return. Now, lastly, with algorithmic trading added to the mix, in this scenario, you could have seen a 763% return over the same 10 years, which is a drastic difference in the account balance. Now, like I mentioned, this is hypothetical and not indicative of future performance. But when we take a deeper dive, that's a differential of $923,000 over the course of 10 years. That's about a 7.6x return rather than a 2.8 with a traditional portfolio. And so we illustrate that because with what we're doing here, we are a software and education company, and you get to select a strategy to integrate into your portfolio to whatever degree that you'd like. And it's very simple. You follow three steps of funding your broker account, syncing the software, and managing the portfolio. Now, we help provide a white glove concierge service through all of this, but you are responsible for depositing, withdrawing funds. You can turn on and off the algorithm and the software at any time. You are responsible for all of your logins, and you are responsible for all the withdrawals that you do, understanding the tax implications with it. So this is why we help provide people the education, the resources, understanding what it is that they're doing, so that way when they communicate with their CPAs and tax professionals, they're able to get the full picture by working with us through our program. Now, a lot of times when people see great returns from an asset class, whether they're looking into the past, whether they're running different scenarios, the saying always comes out that the best time to plant a tree was 10 years ago. But the good news is that the second best time is today. We can beat ourselves up by, wishing things were available sooner, wishing that you had the money sooner, or wishing that you were invested into something sooner. But the second best time to get into something is today. And so, with that said, I know that we have a call coming up here. I hope that you ask the questions that you want to learn from us and our team and how we can best help you integrate algorithmic trading into your portfolio if this seems to be a great fit for you. Looking forward to seeing you on the call. Talk soon.